Coming up today, stocks continue their slide. Could this turn into a big correction? The warning to the US from the IMF. Why oil could head lower? Are we going into a new trade war with China? And the biggest bearish indicator of them all. And welcome back to the Click Capital channel, everybody. Where unlike mainstream media, I can freely speak my mind and get you closer to the truth of what's really driving financial markets and understand exactly what's happening out there so we can all make better financial decisions. So thank you to all of those who support independent financial journalism like this channel, Click Capital. And I'll start off by updating you at the surface level of what's happening currently in markets. We've got the S&P 500, along with pretty much every other risk-on asset, trading lower again today. And to give you a bit of color across financial markets, it's looking red across the board. In the immediate short and medium-term trends, only thing green across the board now is volatility and the dollar index. Almost nowhere to hide out. However, stick with me and I'll show you what is working currently right now. And in markets like this, you want to pay attention to what actually is working, as these changes can persist for some months. And so ever since we got this bearish engulfing candle earlier this month, we did a little retracement, market coiled up, and it started rolling over, and now we're sliding. And so this is not a good sign for the months ahead. It's definitely a weakening of this parabolic trend we've been in since late October. However, in the immediate short term, we're looking a little technically oversold here. I can see that on my S&P 500 oscillator. This is my own custom indicator that doesn't just look at market technicals, looks underneath the hood at market internals, breadth, volatility term structure, retail sentiment, so on and so forth. And so that's the first time we've gone technically oversold since early October, going into late October, where we got a little bounce before finding the big low at 4,100. Previously back in mid-August, we were oversold and bounced. Same with the regional banking hiccup. In March last year, we got oversold and bounced. And prior to that was the bear market low in October 2022. We were oversold on a divergence and we bounced up. So this indicator does a much better job at identifying near-term lows than tops due to the nature of the market. Doesn't mean we can't go lower here. However, we are approaching that big psychological 5,000 level on the S&P 500 where the market may take pause and potentially have a little bounce and retracement where we could still hold this short-term downtrend. And there's a few things as to why I think we maybe get a short-term bounce here. We've got the short-term breadth, amount of stocks above the 20-day average, just about as low as it gets now on a 7 handle. And on a day where it's pretty much red across the board and growth assets, we actually had the VIX drop. But what really caught my eye today was the spike in the put-call ratio. That is a lot of people buying puts today. And we can see that looking at the options market and highly traded assets like Tesla, 5.7 billion notional put volumes versus 876 million in notional calls. Same deal with S&P 500, the Nasdaq, the Russell, 1.27 billion versus 116 million, AMD, Apple, and quite a few others. A lot of put volume activity today. And what was a pretty busy Wednesday session. Normally midweek we'd only trade around 37, 38, 39 million contracts. Today we're approaching 46 million and a big change, 54% puts versus calls. We've been massively lopsided towards calls for months now. And just looking at those single leg puts, those are option trades that don't involve a spread, what they call multi-leg. 72% of them are expiring in the next 5 days. And typically that's a bit of a contrarian signal in the short term. When everyone's loading into hedges and puts, normally we get a bounce. Doesn't mean we can't slide, break through that 5,000 level. There's no pattern or indicator. Works 100% of the time. However, if the market was to hold around 5,000, I'd say we could get a bounce back up. However, a clean close below 5,000, especially on hard volume, may potentially mean we're on our way down to what I'd say the next area of support should be, and that should be around 47.50. That's about a 50% retracement off this recent move from the October lows. And that is where I'd expect the stock market to find some footing and will have given us a healthy 10% correction this year as well. Because looking at the move higher in bond yields, that more than justifies a healthy correction in the stock market, in addition to what seems like a new regime of volatility as well. We may not see these 13-12 handles for quite some time, especially as the market prices in more and more volatility going into the US presidential election on the 5th of November. Not to mention the market's still on knife's edge, waiting to see exactly what sort of response Israel gives towards Iran, which could well and truly happen this weekend when markets are shut. And if we were to breach that big important 5,000 level on the S&P 500, we could quickly accelerate down towards 4,700. And that's because, like Goldman Sachs estimates, commodity trading advisors, who are largely trend followers, the lower we go and break that trend, the more they'll be exiting their longs and potentially adding to new shorts. And over the next week, if the market were to hold up, Goldman estimates they'll sell about 2.7 billion of stocks. If we're flat, 7.5 billion. However, if the market were to continue down, they estimate they'll over $14 billion worth to sell, which could add towards the downside momentum, in addition to the huge amount of vol target funds having to reduce their equity exposure as well. And when you've had a market like this one for the last couple of months, it inevitably attracts a lot of hot money that can all rush for the exit doors at once, and we may not have seen that full uncoiling yet. So like I said, I'm looking for 5,000 to hold here for a little bounce. If not, we're looking for it to find some support around the level where we actually started the year off. And so just looking at what is working today, we've got gold miners up 1.5% and a little bit of a defensive rotation. Consumer staples popped up a little bit and utilities actually finished up 2%. We can see momentum, the worst performing factor today. Low volatility stocks actually holding a bid, but the best performing sector today, and one of my favorites, cannabis. MSOS up 6.2%, back above its 50-day VWAP, and that was the place to hide out today. On an otherwise pretty red tape, especially in growth assets, got NVDA, along with most other semis, coming off hard, down 3.8%. AMD losing key support, down 5.7%. Recently hot semi, ARM Holdings, down 12%, and Alphabet Google, the only mega cap tech, increasing today, along with the bounce and Trump Media, up 15.5%. Looking a bit technically oversold here. Got my reversal signals firing off. DSI's oversold, negative momentum and trend, and we are a huge 54% below the 50-day VWAP. But of course, in a wild stock like this, anything is possible. And I'd say a big part of why we're pulling back now, that the bond market and the rest of us have already seen for a couple of months, is Jay Powell just recently confirming that it appears inflation is not going in the direction that they want. And so if we hear more hawkish commentary from Jay, that could cement a stock market correction. But like I've been saying, the US government can't really afford even rates to stay where they are now for many more years. Interest expense over $1 trillion, about a quarter of what they make each year, and that's set to keep exploding higher even if rates stay the same. So there's a real strong political will to get rates down and to do whatever is needed to accomplish that. However, stepping back and looking at the big picture and looking at a unique valuation measure, that's US cash rates divided by the US dividend yield on the S&P 500. So you could kind of think of that as what you can earn risk-free, keeping your money in short-term cash, versus what holding S&P 500 will pay you in dividends. And it's pretty elevated here. Looking back in history, it was only higher back in the late 90s in the tech boom. However, like all valuation measures, we're looking at 100 years here. Things have changed in that time, especially since we went off the gold standard in 1971, the electrification of markets in the 80s, and of course, the relatively new quantitative easing by the Fed, in which they electronically print trillions of dollars of new money and then turn around and buy US treasuries and mortgage-backed securities. In addition to a lot of mandatory laws around the world where portions of people's salaries are just drip-fed into the market, all that leads to structurally higher valuations in the stock market. However, even considering that, we still may be a little stretched here looking at the long term. But holding things up right now is US exceptionalism, with their economy performing the best out of all Western developed economies. However, that comes at the cost of inflation not going away. And the most aggressive Fed rate hiking cycle in history didn't actually topple the economy, spike unemployment and cause a recession, just kind of slowed things down for a bit. And now Jay Powell's commentary in late October, pivoting to hawkish from dovish, reignited animal spirits, and has probably just added fuel to the resurgence in inflation. And here's a look at some charts to show you how the market's expectations and what's actually happened over time. The first one you're looking at here is the probability of a recession in the next 12 months. And coming into 23, most of us were expecting that to happen, as that's what history was telling us. However, in the latest survey, only 29% of us are expecting a recession in the next 12 months. And just looking at the evolution of growth forecasts for US quarterly GDP growth, have consistently fallen short of actual growth in the past year. Starting off in fourth quarter 2022, forecasts were for it to go negative into the third quarter 23. So here in the black line, you can see what actually happened, and then the new forecasts from that quarter. Growth held up, forecasts went up, growth actually spiked in third quarter last year, and it, along with it, has helped lift up forecasts. So the US economy has surprised many. Even the Fed themselves have said it's been remarkably resilient in the face of high interest rates. I'd say a big part of that is the AI boom last year, in addition to record amount of government spending, of course. And so the Fed economists in the market don't actually always get it right. Here's a look at forecasts for core PC inflation, the Fed's preferred gauge of inflation. Forecasters back in late 21 were actually expecting that to get down to 2.2% by December 22. Just a little bit wrong there. Actually finished at 5.4%. The most recent forecasts were more in line with what actually happened, and looking at future forecasts, they're looking towards PC inflation to come in at 2.1% December next year. Even Fed Fund futures don't always get it right, and this caught a lot of big banks off guard in early 22 as well. They piled into bonds, now have huge unrealized losses on their balance sheet. Fed Fund futures were increasing a marginal increase and Fed funds rate, even under 1% in December 23. Market was convinced we were going to stay lower for longer. Fed actually shot rates up, and at different points of time, the market's always been quite optimistic that we're done with inflation, and here we are today. The forecasts are, come December next year, overnight cash rate should be around 3.5%. And not one to usually issue big warnings to the United States is the International Monetary Fund. It's worried about global spillovers from loose US fiscal policy. That means they're worried about how much money the US government is spending. And since we live in a synchronized world that causes inflation right around the globe, they've come out and urged Washington to reduce its budget deficit. That is the difference between what they make and what they spend each year, growing at alarming rates, with the deficit rising to 8.8% of GDP last year, more than double of that in 22. At the same time, the IMF has said the risk of a global recession is minimal and that it would take a lot to derail the current strong economic performance from the US and several emerging market economies. And so even though Washington's debt is a serious long-term problem, and we've recently seen signs of weakening auctions, it's not always the case. We actually had a successful 20-year Treasury auction today, in which there was strong demand for $13 billion worth of 20-year Treasuries, causing bond yields to slip a little after they've been on a bit of a run higher lately. There's a look at the 10-year today, still pretty strong, but did just pull back to 4.58. And not only has geopolitical tensions helped to push up gold, it's also the market's expectations that the Fed is still going to go ahead and cut rates, potentially in July or September. And typically lower rates are good for gold. As a non-yielding asset, it competes with other safe assets for investor capital. However, it's actually silver outperforming gold, which is not unusual in a commodity bull market, as silver is a lot more volatile. But we've also got industrial silver demands heading for record highs, and silver on track for the fourth straight yearly supply deficit. And there's a look at the long-term monthly chart of the spread between silver and gold, still more closer to record lows, well off those record highs from 2011, and technically starting to look good, pushing up against this downward channel. And both commodities just consolidating here. There's gold, silver just sitting below a big resistance zone. And just moving on to oil, we had a bit of a pullback here today as weekly supplies came in higher than expected, and the Biden administration is doing everything it can to keep a lid on the price of oil going into the elections, saying to let sanctions relief on Venezuela's oil and gas sector lapse, meaning that oil-rich country can bump up their exports of crude, adding further supply onto the global market. And the weekly crude oil stocks change came in much higher than expected. However, what I think the oil market has really taken notice of this last day is reports that Biden is likely to tap the Strategic Petroleum Reserve. That's the huge amount of oil that was initially set up to keep as a backup in times of national emergencies and wars. However, with gas prices on the rise lately, rising geopolitical tensions, just like we saw after Russia invaded Ukraine, the Biden administration emptied a large part of the SPR to help counteract the high price of oil and flood the market with supply, and we may be getting that again soon to help keep prices of gas down and inflation. However, this comes at a time when the SPR at 364 million barrels is at the same level it was in 1983, and this is coming ahead of a potential retaliatory strike from Israel towards Iran. Many Israeli political hawks want to go bigger than Iran in their response, and that could cause devastating damage on the Iranian regime, as they don't have the same defensive technology that us here in the West have. Even though the US government is pressing for the Israelis to only give a minimal response, if any at all. However, like we've been seeing this last month or so, Israeli Prime Minister Netanyahu and his team kind of been going against US wishes and dialing it up on their own accord and trying to get everyone's focus and attention back on towards the Iranians. So it's likely Israel is still trying to work out what sort of response they're going to give. It may come this weekend when oil markets are shut, or potentially next weekend when everyone may have written it off that they're not going to do anything, kind of forgotten about it, and then it may just come out of the blue with what Israel is going to do back to Iran. Not only that, we've got US ports preparing for cyber attacks, as Google's just come out and shown links between Russian hackers and a January attack on a water filtration plant in a small Texas town, saying the nation's largest ports are also at risk, with all security measures and assets currently being reviewed, with some known links to the Chinese, and this is very important infrastructure in any country. And so governments, the Federal Reserve, everyone's keen to see the Middle East situation dial down, the price of oil to come down, because they really just want to get out there and cut rates. And so if Israel does go ahead with a big attack on Iran, which they may not, the US-led Western alliance is not likely to be happy with them, so they may do something more covert or over time, targeting their leadership rather than a widespread attack on their military assets. After Janet Yellen's recent trip to China trying to talk them down on flooding key markets. With cheap products, we've now got dialed up signs of fresh trade war, with Biden and his team talking up tariffs on Chinese imports, and which can be a double-edged sword for the economy and inflation. If the price of imports increase, that increases inflation. However, it can also help to protect local industries, help win the votes from a lot of unionized businesses, and potentially cool off economic activity as well. And we saw this in the Trump years. They were big headlines back then between China and the States, and this especially affects industries like steel, with Biden potentially going to increase China tariffs on steel and aluminium, and is even called China xenophobic, which means a fear of all things foreign. Moving on to crypto, we've got a bit of a pullback in Bitcoin and Ethereum going into the halving event on Friday. Selling actually kicked off in the middle of Iran's attack over the weekend on Israel. Basically the only market that's open. A lot of crypto bulls argue for Bitcoin as being a safe haven asset. However, it's more like a proxy for liquidity and risk. When animal spirits are flowing, so's cryptos, meme coins. However, when they're not, then we go the other way. And it may be a case of all Bitcoin bulls are already as long as they can be. Everyone that wanted to get into these new ETFs are already in, and it may just be a case of we've run out of fresh buyers for now, as we've just taken out this support zone I'd been watching, briefly getting below $60,000 a coin today, and Ethereum looking a little weak there as well. Coming out of time when we've got a bit of dollar strength and a bit of flight to cash. We've also got more and more on the street turning against Tesla, now with Barclays slashing its price target by 20%, giving 3 reasons why next week's Q1 earnings calls will disappoint. Saying they expect them to miss on gross margins, free cash flow may be negative for the first quarter in 4 years, and that investors will have many questions of which they think will go unanswered. And so there we are on Tesla, kind of just coiling up today, finishing a little lower, lost that big support zone. See if it can come and retest. Otherwise, it seems to be in a bit of a persistent downtrend here. And unfortunately for Tesla bulls, you just got one of the biggest contrarian indicators there are, and that's the perennial underperforming fund manager, Cathie Wood, continually buying more Tesla stock as it slides lower. So we very well could see Tesla at $100 a share at some point this year. Looking out to economic data tomorrow, we've got weekly jobless claims, along with a few Fed speakers, in which they may change their tune and come out a little hawkish, in line with Jay as well. Fed's recently been criticised for having a lot of mixed commentary within their various members, and they may come out with a more uniformed tune, pushing back on the calls for rate cuts and reiterating Jay's line, they need to stay on hold and see how bad this uptick inflation is going to get. But regardless, the market still thinks they're going to cut in September. Government's really got their work cut out, keep a lid on oil, big influence on inflation, so I'd say it's very likely Biden administration opens up the Strategic Petroleum Reserve, and traders in the oil market may be leaning against that as a bit of a line of resistance. Knowing the higher oil spikes, the more likely the SPR will get opened up, and I'd say that's why oil had its biggest down day for a while, off 3%, now back at its 50-day VWAP, and this is likely to consolidate here and potentially come and test $80 a barrel in the coming days. Market's still getting a little bit more nervous, fear and greed at 35. This is when we can see short-term bottoms, if not usually in the extreme fear zone. We're pretty close to a bottom. And corporate insiders, slight uptick in selling yesterday, still not doing much buying at all, which is a little unusual when the market's dipping. Typically we see a little bit of an uptick in corporate insiders buying as the market comes off, as they're contrarian in nature. There's a look at high yield bonds, actually hanging in there today, up a little bit. Agricultural commodities, other place to hide out, increasing again today. And looks like coffee's going the way of cocoa. Strong parabolic rip here on a bit of volume as well. And there's a look at the spread between consumer discretionary and consumer staple stocks. Trading down a bit here today, kind of a risk on spread coming off. Same with high yield bonds versus treasuries. Trading down a bit towards the lower end of this trend channel, and a sizable move lower for the semiconductor sector, down 3% today on volume, and AMARC continues to make its way back to the 50-day VWAP with a bit of a hard sell-off in hot stock DraftKings. Wingstop still holding up there though, and defense, and some defensive stocks holding a bit of a bid, along with some of the food makers, consumer staples, and a bit of a bounce back for the big banks, not so much for JP Morgan, which could also be approaching a bit of a short-term bounce. Alright guys, there we have it for today. Market continues this pullback. Just to recap what I said, we're looking for 5,000 to hold. If not, we may get a proper uncoiling towards 4,700. And as I showed you, only a couple of places to hide out. It's looking pretty much red across the board in risk-on assets. Thanks very much for tuning in and hitting that like button. I'm always interested to hear your thoughts. You're welcome to drop a comment below this video. I reply to everyone. Otherwise, I'll see all you guys again tomorrow night. Cheers.